What if your mortgage, your single biggest debt right now, could become your single most powerful wealth building tool? The Smith Maneuver promises just that. But in today's high interest rate environment, one little mistake can become catastrophic. In this video, I've actually broken out into little chapters so you can understand what is the Smith Maneuver. You can understand how it works step by step, what are the biggest risks involved for you, and a case study to put it all together. So, what exactly is this powerful and potentially risky strategy? Well, at its core, the Smith Maneuver is a completely legal Canadian tax strategy first developed by financial planner Fraser Smith. It is designed to do one powerful thing: transform the bad debt in your mortgage into good debt that the government lets you deduct on your tax return. Because as it stands right now, you cannot deduct your mortgage on your tax return. But if you play the strategy just right, you absolutely can. Think about it. The interest you pay on your car loan, your credit card loan, and especially your mortgage, after you pay it, it just disappears. It's a pure expense, and that's why it's bad debt. But the interest on a loan that you use to generate investment income, that's good debt because the CRA allows you to deduct that interest and lower your taxes. The Smith Maneuver is essentially a bridge between the two, transforming your bad debt into good debt. The best way to understand all this is to think of your home's equity as a financial recycling plant. Right now, this is the most common scenario. You go ahead and you make your regular mortgage payment, and a portion of that payment pays down your principal, which is great because you're building home equity. But the problem is that the value gets locked away and it becomes inaccessible. It's like stuffing cash under a mattress. It's there, it's yours, it's safe, but it's not doing anything for you. It's not working hard for you. It's pretty much lazy money sitting idle instead of generating more wealth for you. And this is where the Smith Maneuver kicks in. It pretty much installs a recycling machine inside your mortgage. And this machine is a very specific type of financial product known as a readvanceable mortgage. You've probably seen them every time you walk into your bank. Products like the Scotia Step, TD Home Equity Flexline, or BMO's Line. They combine a regular mortgage with a home equity line of credit, or Heloc for short. Here's how the recycling plant works. Every single dollar of principal that you pay down from your mortgage payment is immediately recycled. And that exact amount becomes available for you to borrow from the attached Heloc. Now, this is the most important and critical part of this entire strategy. That recycled money that you borrow can only be used for one purpose: to invest with a goal of producing income. Now, let's put it all together by using this graphic. You are borrowing from your Heloc and buy income producing assets like dividend paying stocks, ETFs, or even a rental property. However, you cannot use this money for a vacation, a new car, or to top up your TFSA or RSP. That's where the strategy fails. Because you're using that loan to invest, the interest you pay on that Heloc is now considered to be investment loan interest, and that's what makes it tax deductible. And if you do this correctly, you have successfully transformed your bad mortgage debt, recycled it, and turned it into good tax deductible investment debt. And that is the Smith Maneuver in a nutshell. But knowing the what is one thing, the real power comes from understanding the how, the specific month-to-month mechanics that make the engine run. And I'm going to break that down for you next. Okay, the financial recycling plan sounds great in theory, but what does it actually look like month to month? How does the machine work without grinding you down? Let's walk through the engine room step by step. And it all starts with something you are already doing, and that is making your monthly mortgage payment. Let's say you go ahead and make your standard mortgage payment. Part of the payment will be interest, which just vanishes, and a chunk of it will be used to pay down your principal. In a normal mortgage, that equity is locked up, it's dormant. But with our recycling plant, the readvanceable mortgage, that paid off principal instantly becomes new credit available through your Heloc. The machine has successfully recycled its value. And you do this every single month. Pay down your mortgage, unlock more Heloc. But this leads to the number one question I always get. Now I have a mortgage payment and an investment loan that I have to pay interest on. What gives? Isn't that going to crush my monthly budget? The answer for most people is no. And the secret here is a technique called capitalizing the interest. Now, my duty here is to be incredibly clear on this point. The technique relies on a well established principle with the CRA that tax deductibility is not automatic. You have to work for it. It is 100% conditional on your ability to prove that money trail. The concept is that since the original loan was used to invest, the interest on money borrowed to service that loan can also be deductible provided you maintain a flawless paper trail. So the whole system can run without you needing to find an extra dollar in your budget. Now, quick sidebar here. What I just said was very technical. You probably got the gist of it, but it is very technical. And this is the perfect example of the precision that this strategy demands in order to be successful. My goal in this video is to educate you on what's possible. It is not a substitute for personalized advice because I don't know your specific situation, and everybody's specific situation is going to be different. But at least you get the concept and understand how it works. Before you even think about attempting this for yourself, you have to consult with your own qualified financial advisor to ensure it aligns with your specific financial picture and risk tolerance, something that I don't know in this video. So that's why go out and get professional advice if you want to execute the strategy. Okay, now we have the plant up and running. It's doing its thing. It's converting your mortgage payment into good debt every single month. But how do we put this into hyperdrive? This is where we add accelerants. At this stage, your investments are hopefully generating some investment income because that was the whole point of all this. Maybe you've invested in some dividend stocks, so you're getting dividend income. Maybe you have some ETFs, so you're getting distributions on a regular basis. Or maybe you have rental property income, whatever the case may be. At the end of the year, by the time you get to tax season, you're going to get a very nice tax refund for deducting all that Heloc interest from your taxes. And you're going to get super tempted to spend away that refund, but you will not. With this strategy, every single dollar of investment income that you're making, every single dollar of tax refund that you're getting as a result of the strategy, you're going to use it to make a massive lump sum prepayment on your primary mortgage. This acts as a force multiplier on your mortgage principal. Now, I know that part was also very technical and maybe I lost you, so let me explain it again in more simple terms. Every dollar from your tax refund and your investment income that you're putting as a prepayment on your mortgage is going to aggressively reduce your non-deductible debt. And what happens when you slash your mortgage principal? Hopefully you have the right answer here if you've been following along. You instantly free up a huge new chunk of borrowing from your Heloc for investing. And this, my friends, is a virtuous cycle. This is the engine of the Smith Maneuver in action. It's very powerful, very risky, but it could also run on its own without you having to take an extra dollar out of your budget. Which probably leads you to asking the most important question of all. What's the catch here? Why isn't everybody doing this if it's such a money-making machine? What happens when things go wrong? And that's exactly what we're covering next. So far, we've talked about how powerful the engine of the Smith Maneuver is. Any engine, no matter how powerful it is, can be dangerous if you don't understand the safety protocols. This is the most important part of this entire video. We're going to have a very frank discussion of the risks, the rules, and who should absolutely not attempt this strategy. Skipping this section is not an option. There are 5 critical risks that you have to understand emotionally and intellectually before you even think about calling your bank about the strategy. Risk number 1, market risk, and this should be very obvious because you are using borrowed money to invest in the market. When the market goes up, we all feel like geniuses, but markets also go down. And your investments bought with borrowed money, they will go down in value at some point in time. That much is a guarantee. And when that happens, you will still owe the bank every single penny from the Smith Maneuver. And that's why this strategy is designed to be a long-term strategy, 15 years, 20 years, or more. That time frame allows your portfolio to recover from the inevitable downturns. For all you disciplined investors watching this video, when markets go down, it's our opportunity to buy more assets on sale. But the thought of owing the bank more money than your portfolio is actually worth, if that makes you sick, if that makes your stomach turn into a knot, then stop right here. This strategy is not for you. You can pretty much stop watching the video right here. Risk number two, interest rate risk. Your HELOC will have a variable interest rate. When the Bank of Canada raises rates, the cost of borrowing goes up, right? That part is pretty much simple. But there's a very fascinating and counterintuitive detail here. So let's talk about that. Because the interest is tax deductible, the higher the interest rate, the bigger the tax deduction. This naturally creates a bit of a cushion. For example, let's say your HELOC rate is 7% and your marginal tax rate is 40%. That means your tax deduction saves you 2.8%. That is your effective interest rate. That is the interest rate you actually feel, which is 4.2% in this example. This naturally makes the hurdle for interest rates a lot lower. But keep in mind, with the strategy, you are in it for the long haul, right? We've talked about it 20 years. So that means you have to bear in mind that interest rates will fluctuate for over 2 decades if you're in this for the long haul. For this next risk, compliance risk, risk number three, the details here are absolutely critical. And honestly, I can't stress that enough. To make this as crystal clear as I can for you, I'm going to boil this down into its most basic concept. In the eyes of the CRA, it all comes down to one thing: a clean flow of money versus a contaminated one. Let me show you what I mean. This is the paperwork nightmare. The CRA is going to give you a very powerful tax break, but the burden of proof is 100% on you. You have to have a perfect, traceable paper trail showing that every single dollar from the HELOC was used only for investing. This leads to the cardinal sin of the Smith Maneuver, commingling of funds. This is where mixing of personal expenses with your investment loan in the same account can get your entire tax deduction denied. To prevent this, our goal is to create a perfectly clean, traceable paper trail. A common best practice when using the Smith Maneuver is to use a dedicated checking account exclusively for all Smith Maneuver transactions. This method creates an audit trail. Risk number four, structural risk. Many people worry about something called a margin call. This is when the bank forces you to sell your stocks at the worst possible time. Here's a key distinction. A standard HELOC secured by your home does not have margin calls based on your stock portfolio's value. A drop in the market won't trigger your bank to give you a call to sell your stocks. The real risk isn't actually about the stocks in your portfolio. It's actually about your home's value. Let's say the housing market were to crash and your total loan got way too high compared to what your home is now worth. The bank isn't going to give you a margin call. They're going to freeze your HELOC. That means you can't borrow any more money, effectively putting this strategy on ice until the value of your home recovers. Risk number five, behavioral risk. I've saved the most important risk for last. It's not the bank, it's not the CRA, it's not the market, it's the person looking at you in the mirror. This strategy demands immense psychological discipline. I have to ask you, and I need you to be super honest with yourself right now. Can you watch your portfolio that you bought with debt fall 20% or more and not panic sell? Can you have a six-figure line of credit available at your fingertips and resist the temptation to start a home renovation project? If your gut is telling you right now that this feels like you're just gambling your family home, or you're going to lose sleep overnight if the markets get choppy, the Smith Maneuver is not for you, period. And that's not a bad thing. Honestly, having peace of mind and a good night's sleep is the best investment you can make. All right, we've covered the theory, we've talked about the mechanics and the critical risks involved around the strategy. Now let's see what this looks like for a very common home buyer in Canada today. Let's build a case study that starts from day one. Let's meet Liam and Chloe. They've just stretched their budgets to buy their first detached home in the Toronto area. They've managed to pull together the minimum 20% down payment. That's it. They're maxed out. Now let's do something that pretty much no one ever does when they sign a mortgage. Let's look 20 years into the future. What is the financial impact of this strategic decision? Let's run the numbers. All right, in this situation, you can see the spreadsheet on my screen. We're going to compare two paths. Path A, where they just paid their mortgage normally, and path B, where they ran the Smith Maneuver. On path A, you can clearly see that after 20 years, they have pretty much paid down their mortgage significantly, leaving them with a net worth shy of about 1.7 million, all based on the value of their home. But the problem is that's also locked in their home. Still not too bad. Now look at path B. After 20 years of using the Smith Maneuver strategy, their investment portfolio has grown to over $1 million. The investment loan used to fund it, the HELOC, is now sitting at around $802,000. they have a net gain on their portfolio around $250,000. When we compare their final net worth in both paths, the path without the Smith maneuver, there is a difference of over $187,000. But this is the most important part about the story. Now, that net worth might be cool and all 187,000, or for some of you in the comment section, you'll be like, only 187K after 20 years? That's nothing. The real most important part is this. They now own $1 million liquid investment portfolio to fund their future. They have transformed their biggest, largest liability into a powerful wealth building engine that gives them the flexibility and options that the other path simply doesn't provide. The numbers here behind me are very compelling, but numbers don't tell the whole story. So how do you decide which path is right for you? Let's bring it all together. We've covered a lot of ground so far. We've talked about the financial recycling plan and the mechanics of capitalizing interest, all the way to the 20-year case study showing the potential to create a $1 million portfolio. So as we wrap up, what does all this actually mean for you? Well, for one, if you're still watching this, that means this strategy has got you a little bit interested, like you're intrigued by all this. But success isn't guaranteed by the math here, it's determined by you. And it all comes down to 3 non-negotiable pillars. First is patience. This is not a get-rich-quick scheme. It's a build wealth slowly kind of system. And that's why you have the discipline to see the strategy through all the ups, through all the downs, highs and lows, over 15, 20 years or more. Can you stomach the market downturns we've talked about? Can you watch your portfolio that you got with borrowed money go down in value 20%, 50%, and not panic sell? The second is precision. Our tax law is giving us this incredible opportunity, but in return, they demand perfection. Your record keeping has to be meticulous. You need a clean, traceable paper trail proving every single dollar from your Heloc was used to invest in income producing assets. And remember the cardinal sin here, commingling of funds. One wrong move can jeopardize this entire strategy. And third is partnership. This is a very complex strategy with a lot of moving pieces and parts, and it can be very technical, as you likely saw if you watched the whole video. This is not a strategy where you can go on a solo mission or something you can just try out. The risks are honestly pretty high, and the cost of making a mistake is also pretty great. The vast majority of people who successfully execute the strategy work with professionals. They work with a qualified financial planner and also a good accountant too. So the final question shouldn't be, does the Smith maneuver work? You've seen the math, it absolutely can, and it's very powerful. The real question is the Smith maneuver right for you? Do you have the patience to see it through? Do you have the precision to execute this flawlessly? And can you partner with the right people to help you when you need it? And if you can honestly say yes to all three, this could be the single most powerful wealth building tools you can execute. I hope this guide has been valuable for you. And if it has, do me a quick favor, hit that like button and hit that subscribe button so you can get more financial content from you designed to help you build wealth. And I want to hear from you. Based on everything we've talked about, what is the single biggest question you still have on the Smith maneuver? Or maybe you have multiple questions on the Smith maneuver. Let me know all your questions and comments down below in the comment section. I'll be reading every single comment and responding to them as well. Thank you so much for watching. I'm Danish, CPA for the people, helping you make smarter financial decisions. That's it for now. I'll talk to you in the comment section.